All right, let's dive in. Today we're taking a deep dive into Fineotex Chemical Limited, FCL for short. They're a specialty chemicals company based in India, and wow, you've really done your homework on this one. Financial reports, corporate governance details, even transcripts from their investor calls and info about their sustainability efforts.
It's always wise to gather insights from multiple sources, gives us a more complete picture,
Mhm.
helps separate the hype from reality, and understand FCL's position in the market, where they are, where they could be headed.
Okay, so first impressions. FCL is putting up some pretty impressive growth numbers. A 35% jump in profit, expansion into new markets like oil and gas, and even snagging those Great Place to Work awards. On the surface, they seem to be killing it.
Yeah, at first glance, the financials do look quite promising.
But I also noticed their overall sales volume has remained relatively flat. So, how do we square those two things? A big jump in profit, but steady sales.
It's all about strategic shifts. If you dig into their earnings call transcript, it reveals some interesting things. Demand in the fast-moving consumer goods sector, or FMCG, has slowed down.
Okay, so that makes sense. Consumer spending might be down a bit.
Exactly. But at the same time, their textile business is absolutely booming. In fact, they added 30 new customers in textiles just in the third quarter of fiscal year 25.
Ah, so they're capitalizing on the areas where they're seeing strong demand. Smart move. But what about this push into oil and gas? Is that a hedge against the global shift towards renewable energy?
It might seem counterintuitive at first,
Yep.
right? But it's more nuanced than that. The world is undoubtedly moving towards renewables, but traditional energy sources, they're going to remain significant players for many years to come. FCL likely sees this as an opportunity. They can provide those specialized chemicals needed to optimize extraction processes and potentially even reduce the environmental impact.
So they're finding opportunities within the transition, not just jumping on a bandwagon, strategically positioning themselves. And speaking of strategy, they're not putting all their eggs in one basket. They're also targeting the water treatment market.
Absolutely. And they're not just dipping their toes in the water. They're using strategic partnerships and really leveraging industry events to gain traction. For instance, they participated in OTC Houston. That's a major event for the oil and gas industry, and also ADPEC in Abu Dhabi. It's about building relationships and showcasing their expertise in these new sectors.
So calculated steps, not just throwing darts at a board and seeing what sticks. Okay, let's talk hard numbers. Their income from operations jumped a huge 41% in FY24, reaching INR 41,893 lakhs. That's a massive leap. How much of that growth can we attribute to organic growth versus, say, acquisitions?
Well, a significant chunk of that growth comes from their expanded capacity at the Ambernath plant. Remember, they ramped up production to 104,000 MTPA. That's a pretty clear indicator they're anticipating strong demand.
Right, so they're putting their money where their mouth is. But is this expansion fueled solely by existing products, or are they branching out with new offerings as well?
It's a mix, actually. They highlighted the development of new products in their reports, one specifically called AquaStrike Premium. They believe this is going to play a key role in future growth.
Hold on, AquaStripe Premium. Now you've got to break that down for me. Sometimes I need things spelled out. What exactly is this new product?
Well, the details are a bit scarce at this point. It's a new addition to their product line, that much we know. But based on what they've said, it's likely some kind of high-performance chemical formulation designed for a specific application. The fact that they highlighted it during the earnings call tells us they see real market potential there.
So new products, new markets, expanding capacity. They're certainly not resting on their laurels.
Yeah.
But all of this expansion, it has to be costing them a fortune. What's their debt situation look like? Are they racking up massive loans to fuel this growth?
And this is where it gets even more interesting. They're practically debt-free. They've managed to finance this expansion while maintaining an incredibly low debt profile. It's pretty remarkable.
Wow, that's impressive. But it also raises a question. Could they be missing out on potential growth opportunities by playing it so safe?
It's a balancing act, right? Prudence versus seizing the moment.
Exactly. It's a question investors should be asking themselves. Maybe playing it safe isn't always the best strategy, especially in a fast-paced market.
Definitely something to think about. Now, let's talk about their commitment to sustainability. They've been making a lot of noise about their ESG initiatives. But how much of it is substance and how much is just marketing hype?
It seems to be more than just lip service. They've got this platform called Beehive, for instance.
Beehive.
Yeah, it's really interesting. It promotes transparency and the use of sustainable chemistry throughout the entire textile supply chain. Okay, so they're not just focused on reducing their own footprint. They're trying to influence the entire industry. That's ambitious, but are they actually putting their money where their mouth is? Or is this just clever PR?
Well, their sustainability reports provide a lot of detail. They've got a whole range of initiatives in place, from energy conservation measures to waste reduction programs. They're even promoting sustainable sourcing practices with their suppliers. And get this, they've installed a solar power plant at their Ambernath facility.
Wow, okay, so they are taking concrete steps. But what's the impact of all these green initiatives on their bottom line? Is it costing them a fortune, or is it actually making them more profitable?
That's the million-dollar question for investors, right? It's tough to say definitively. Their sustainability reports don't explicitly link these initiatives to financial performance. But you have to consider the bigger picture. A strong ESG profile can be a huge draw for certain investors who prioritize sustainability. That can boost their stock value and open up new funding opportunities.
So it's like a virtuous cycle. Doing good leads to doing well, which allows them to do even more good. All right, let's move on to corporate governance. What kind of insights can we glean from the reports and earnings calls? How are they managing the company, and are they doing it responsibly?
One thing that stands out is the composition of their board of directors. They have a good mix of executive and independent directors, which is important for ensuring balance and independent oversight.
Checks and balances, right. But are they truly transparent, or are they sweeping things under the rug?
From the information you've provided, they seem pretty committed to investor relations. They hold regular earnings calls, provide detailed financial reports, and their investor relations team is readily accessible, which is always a good sign.
Accessibility is key, especially for investors who value open communication.
Hmm.
Speaking of which, let's dive into those earnings call transcripts. What kind of gold nuggets can we unearth from those conversations?
Oh, these transcripts are a treasure trove of information. They give us a real behind-the-scenes look at how management interacts with analysts and investors, how they handle those tough questions, and their overall transparency about their performance and challenges.
All right, let's crack open these transcripts and see what we can find. What jumps out at you as you skim through these documents?
Well, one thing that strikes me is their candor about the challenges they're facing. For example, they openly acknowledge the volatility in raw material prices and the impact that's having on their input costs.
Right, they're not sugarcoating things. They also mention the shortage of shipping containers causing logistical headaches. It's a problem everyone's dealing with these days.
Exactly. These are real-world issues that every company in their sector is grappling with.
Yeah.
It's not about pretending everything is perfect. It's about how they're responding to these challenges.
So are they just crossing their fingers and hoping for the best, or do they have a plan?
It looks like they've got a multi-pronged approach. They're strengthening relationships with their suppliers to ensure a steady flow of raw materials. They're also exploring alternative sourcing options to reduce their reliance on any single supplier. And they're implementing hedging strategies to mitigate the impact of currency fluctuations.
Smart moves. They're spreading the risk and protecting themselves from those market swings. But what about the specific challenges of expanding into new markets? How are they mitigating those risks?
Partnerships are a big part of their strategy. They've teamed up with established players in the oil and gas and water treatment industries.
So it's like having local guides in uncharted territory. They're tapping into existing networks and expertise.
Exactly.
Yeah.
And let's not forget their investment in research and development. They're creating innovative products tailored to the specific needs of these new markets.
So they're not just repackaging their old products, they're developing new solutions. That's a smart way to differentiate themselves and carve out a niche in these new markets. Okay, we've covered a lot of ground. They're managing risks on multiple fronts. Supply chain disruptions, currency fluctuations, entering new markets. They seem to have a good handle on things. But there's one more area I want to explore before we wrap up this part of our deep dive: their investment in employee well-being. They've been racking up those Great Place to Work awards, but what's the real story behind those accolades?
It's an important point, often overlooked. A happy and engaged workforce, that's a huge asset. They're more productive, more innovative, and less likely to jump ship.
So those awards, they're not just for show.
Yeah.
They actually represent a strategic investment in their most valuable asset, their people. But how does this translate into tangible benefits? How does a happy workforce impact their bottom line?
Think about it this way. A happy workforce means lower turnover costs, improved operational efficiency, and a more stable work environment. They're less likely to lose those skilled employees, which is especially critical in a specialized field like chemical manufacturing.
So happy employees equals lower risks and potentially higher profits. That's a compelling argument. Now let's circle back to investor relations and transparency. They seem to be doing a lot of things right, but are they truly committed to open and honest communication with investors?
From what we've seen in the documents you've provided, they seem to be pretty transparent. They're offering detailed financial reporting, holding regular earnings calls, and their investor relations team is easily accessible.
That's all good, but are they just telling investors what they want to hear, or are they genuinely committed to transparency? How can we tell?
Well, let's take a closer look at those earnings call transcripts again. What we see in these conversations is a willingness to engage in detailed discussions, not just about the good stuff, but also about their financials, strategic priorities, and even the risks they face. They're not shying away from those tough questions.
Okay, let's dive back into those transcripts and see what we can uncover. What are some of the key takeaways from these conversations? What's the tone and the level of detail they're providing?
One recurring theme is their confidence in their long-term growth prospects. They consistently emphasize their commitment to innovation, their strategic expansion into new markets, and their focus on developing high-value, specialized products. They seem to have a clear vision for the future.
That's promising, but are they addressing the potential risks with the same level of candor? Are they acknowledging the challenges and uncertainties?
Yes, absolutely. They're quite upfront about the headwinds they're facing. They talk about the volatility of raw material prices, the competitive pressures in certain segments, and the logistical challenges everyone's facing.
So they're not trying to paint a perfect picture. They're being realistic about the challenges.
Exactly. And what's more, they go into detail about their strategies for mitigating those risks. That demonstrates a level of accountability and a willingness to engage with investors on those issues.
They're open and honest, willing to answer the tough questions, and accessible. Sounds like they're ticking all the boxes for transparency.
They were certainly making a strong case. But remember, due diligence is about more than just checking boxes. It's about understanding the nuances, the potential pitfalls, those factors that could make or break a company's success.
Right, no investment is without risk. But so far, FCL is presenting a pretty compelling story.
They are indeed. Now let's shift gears and delve into their sustainability efforts in more detail. They've provided a wealth of information on their initiatives, but we need to dig deeper and see how they measure up against industry best practices.
Okay, let's unpack their sustainability story. First off, I was impressed by their efforts to reduce their environmental impact. From energy conservation to waste reduction, they seem to be pulling out all the stops.
Yeah, they're definitely not just sitting on the sidelines. They've implemented a whole slew of initiatives and are actively collaborating with their suppliers to promote more sustainable sourcing practices.
So it's not just about their own operations, they're trying to influence the entire supply chain. That's commendable. But what about their social responsibility? Are they doing anything to benefit their employees and the community, or are they just focused on the environmental side of things?
They've got programs focused on employee well-being, diversity and inclusion, and community engagement.
Mm.
It seems like they're genuinely trying to create a positive and supportive work environment.
It sounds like they're making a real effort to be a good corporate citizen. But what about governance? How are they ensuring ethical conduct and responsible decision-making at the top?
They've implemented a pretty robust corporate governance framework, which is encouraging. They've got a clear code of conduct, a whistleblower policy, and systems for monitoring compliance.
So it's good to see they're taking governance seriously, but how do their sustainability efforts stack up against global standards? Are they in line with what's expected of leading companies in this space?
It's interesting, their sustainability reports actually show that they've aligned their efforts with the United Nations Sustainable Development Goals, the SDGs.
The SDGs.
Yes, those are globally recognized goals for sustainable development. It shows they're not just setting their own internal standards, they're benchmarking themselves against international best practices.
Okay, so they're thinking globally. That's impressive. But what are some of the potential challenges they might encounter in their sustainability journey? It's not always smooth sailing, right?
One challenge is ensuring that these efforts are truly integrated into every aspect of their business. It can't just be a separate initiative. And they'll need to be transparent about how they're measuring and reporting their progress. Investors want to see concrete results, not just vague promises.
Right. They need to show they're making a tangible difference. And as sustainability standards continue to evolve, they'll need to stay ahead of the curve. What's considered best practice today might not be enough tomorrow.
Absolutely. It's an ongoing process of learning, adapting, and constantly improving.
Right.
But from what we've seen so far, it seems like FCL is off to a good start. They're putting in the effort and aligning themselves with global best practices.
They're on the right track. Now let's move on to their corporate governance structure and practices. What can we learn from their corporate governance reports? What's the story behind the structure they have in place?
Well, a good starting point is always the composition of the board of directors. We want to see a balanced board with a mix of independent and executive directors, each bringing diverse skills and experiences to the table. That's essential for providing effective oversight and making sound decisions.
Right. A well-rounded board with diverse perspectives is key. So, what's the makeup of FCL's board? How does it stack up?
It's encouraging to see that FCL's board has a majority of independent directors. That's a good sign. It helps ensure that decisions are being made in the best interests of all shareholders, not just those in management.
That's a check in the plus column. What about the role of the chairman? Is that an independent role or is it held by the CEO?
In this case, the chairman is also the managing director, which is a fairly common practice in India.
Doesn't that raise some concerns about the separation of power? The board's ability to independently scrutinize management's decisions.
It's a valid concern. But it seems FCL has tried to mitigate this potential conflict of interest by establishing a strong system of checks and balances through independent committees. Each committee has clear mandates and responsibilities to ensure proper oversight.
Okay, so tell me more about these committees. What role do they play in FCL's corporate governance structure? How do they provide that oversight and accountability?
So they've established several key committees. You've got the Audit Committee, the Nomination and Remuneration Committee, and a Stakeholders Grievances Committee. Each committee focuses on specific areas of the company's operations and reports back to the board, ensuring transparency and accountability.
Let's break those down, starting with the audit committee. What's their primary responsibility? What do they focus on?
The Audit Committee is essentially the financial watchdog. They oversee the company's financial reporting process, making sure everything is accurate and compliant with accounting standards and regulations. They also keep a close eye on the company's internal controls and the audit function.
So they're the ones making sure everything is on the up and up, financially speaking. What about the nomination and remuneration committee? What's their role?
They're responsible for a couple of key things. First, they recommend candidates for the board of directors, ensuring the board has the right mix of skills and experience. They also evaluate the performance of existing board members. And importantly, they set the remuneration for directors and senior management, making sure compensation is aligned with performance and market standards.
So they decide how much the big wigs get paid. Interesting. And what about the stakeholders grievances committee? What do they handle?
They're the ones who address concerns and complaints from all the different stakeholders, including employees, customers, suppliers, and the community at large. Their role is to make sure the company is responsive to feedback and addresses any issues that arise.
So they're the voice of the people, making sure everyone feels heard and that the company is held accountable to its stakeholders. All in all, it sounds like FCL has a pretty solid corporate governance structure in place. Multiple layers of oversight.
They do. On paper, they seem to have a well-balanced board, independent committees with clear responsibilities, and a process for addressing stakeholder concerns.
But is it all just for show? Are they just going through the motions, or is their commitment to good governance genuine? How can we really tell?
That's the tricky part. While the structures and policies are important, corporate governance is ultimately about a culture of integrity, transparency, and accountability. That's harder to assess just from documents. We'd need to look deeper into their track record and how they interact with stakeholders to truly gauge their commitment.
Right, actions speak louder than words. For now, though, let's move on to their investor relations and transparency. How effectively are they communicating with investors? Are they doing a good job of keeping them informed and engaged?
Let's start with the basics. Their investor relations website. Do they make it easy for investors to find key information? Things like financial reports, corporate governance documents, and so on.
Let me pull up their website. Okay, yeah, their investor relations section is actually quite comprehensive. All the essential information is readily available and easy to find. They've got everything organized and laid out clearly.
That's a good sign. It shows they're making an effort to be transparent and accessible to investors.
They also have a dedicated section for news and announcements, which seems to be updated pretty regularly. And they even have a contact form for investors to reach out with questions.
That's another positive indicator. It suggests they're proactive in their communication and responsive to investor inquiries. They're not just putting information out there and hoping for the best. They're actively engaging with investors.
Okay, so their website gets a thumbs up. What else should we be looking at? What other clues can help us assess their investor relations efforts?
Well, as we've already seen, those earnings call transcripts can be incredibly insightful. They give us a real-time glimpse into how management communicates with investors, how transparent they are about their performance, and how they handle those challenging questions that inevitably come up.
Okay, let's revisit those transcripts and see what we can glean from those conversations. What are your initial observations? What stands out to you about how they interact with analysts and investors?
One thing that strikes me is their willingness to go into detail. They're not just giving canned responses or avoiding tough questions. They seem genuinely interested in providing investors with a clear and comprehensive understanding of the business, the good and the bad.
It's refreshing to see that level of candor. So often, companies try to paint a rosy picture, even when things aren't going so well.
Exactly. Transparency and authenticity go a long way in building trust with investors. FCL seems to understand that.
So they're open and honest, willing to answer those difficult questions, and they're easily accessible to investors. But what about their disclosure practices? Are they providing investors with all the information they need to make informed decisions? Are they holding anything back?
Based on the documents you've provided, their disclosure practices seem pretty robust. They're providing detailed financial statements, comprehensive corporate governance reports, and regular updates on their sustainability initiatives. They're not hiding in the shadows, they're putting it all out there.
That's reassuring. But are there any red flags? Any areas where their disclosure practices might fall short? Anything investors should be wary of?
Well, one area that investors should always scrutinize is related party transactions. These are transactions between the company and entities or individuals who have a close relationship with the company. While FCL does disclose these transactions in their financial statements, it's always wise to take a closer look and make sure they're being conducted at arm's length and in the best interests of all shareholders, not just a select few.
Right. Those related party transactions can sometimes raise concerns about conflicts of interest, so it's important to make sure everything is above board. Anything else investors should keep an eye on? Any other potential areas of concern?
Another area to watch is executive compensation. While they do disclose their remuneration policies, investors should always assess whether those policies are aligned with the company's performance and whether they incentivize long-term value creation. It's about making sure executives are rewarded for delivering results, not just for being in the right position.
Makes sense. You don't want executives getting rich while the company struggles. So it's not just about what they're disclosing right now, it's also about their track record. Have they been consistent in their disclosures? Have they responded promptly and effectively to investor concerns in the past?
Exactly. Past behavior can be a good predictor of future actions. It's about looking beyond the current snapshot and understanding their long-term approach to transparency and accountability.
Solid advice. It sounds like FCL is doing a lot of things right when it comes to investor relations and transparency. But as you said, due diligence is an ongoing process. Investors need to stay vigilant, keep asking those tough questions, and make sure the company continues to uphold those high standards.
Couldn't have said it better myself. Now let's move on to something a bit more nuanced, their sustainability efforts. We've touched on this briefly, but I think it's worth digging deeper into the specifics. What are they doing to reduce their environmental impact, promote social responsibility, and ensure good governance? Are they truly walking the walk?
All right, let's peel back the layers of their sustainability story. What are they doing beyond those flashy headlines and awards?
Let's start with their environmental initiatives. They've been talking a big game about reducing their carbon footprint, conserving energy, minimizing waste, and promoting sustainable sourcing practices throughout their supply chain. They've even highlighted their solar power plant at their Ambernath facility. But are these initiatives actually making a difference? Are they moving the needle on their environmental performance?
They've definitely got a lot of programs and initiatives in place, but as you said, it's about more than just making promises. We need to see concrete results. So how do we measure the impact of their efforts? What should we be looking for?
Transparency is key. We need to see that they're actually tracking their environmental performance. Are they measuring their energy consumption, their waste generation, their greenhouse gas emissions? Are they setting targets for improvement and reporting on their progress towards those targets? That's what separates the genuine efforts from the greenwashing.
Solid points. We need to see the data, the metrics, the proof that they're walking the walk, not just talking the talk. What about their social responsibility initiatives? Are they giving equal attention to the S in ESG? Are they just focused on the environment, or are they also considering their impact on people?
They're definitely not neglecting the social side of things. Their reports highlight programs focused on employee well-being, diversity and inclusion, and community engagement. These are all positive steps, but again, we need to look beyond the headlines and dig into the details.
So are they measuring employee satisfaction and diversity metrics? Are they tracking their community investments and the impact those investments are having? Are they truly creating a positive and inclusive workplace and contributing to the well-being of their communities?
Exactly. We need to see the evidence, the data points that demonstrate their commitment to social responsibility. And finally, we can't forget about governance. Are they fostering a culture of ethical conduct and responsible decision-making at all levels of the organization? Are they truly walking the walk when it comes to good governance?
They've talked a lot about their robust corporate governance framework, their code of conduct, their whistleblower policy, and their compliance monitoring systems. But are these structures actually effective? Or are they just window dressing? How can we tell if they're truly committed to ethical behavior and responsible decision making?
That's the challenge with assessing governance. It's not always easy to gauge from the outside looking in. We need to look for evidence of their commitment in their actions and decisions, not just in their policy documents. Are they holding themselves accountable to their own standards? Are they being transparent about their challenges and how they're addressing them?
It's about walking the walk, not just talking the talk. So, how can we assess whether their sustainability efforts are genuinely integrated into their business practices? How can we tell if it's more than just a side project or a PR campaign?
We need to examine how sustainability considerations are factored into their strategic planning, their investment decisions, and their day-to-day operations. Are they making those tough choices, those trade-offs between short-term profits and long-term sustainability? Are they holding themselves accountable for their environmental and social impact, even when it's difficult or costly? That's what true commitment looks like.
Those are the tough questions that reveal whether a company's sustainability efforts are genuine or merely a marketing ploy. We need to dig deep and uncover the truth behind the claims.
Precisely. And as we continue our deep dive into FCL's sustainability story, we'll keep those questions in mind. We'll look beyond the headlines, scrutinize the data, and provide you with a clear and insightful assessment of their ESG performance.
It's time to separate the substance from the spin, the real from the rhetoric. Let's see if FCL is truly walking the walk when it comes to sustainability.
Let's peel back the layers and find out. We'll examine their environmental initiatives, their social responsibility programs, and their governance practices in more detail. We'll compare their actions to their words and see if they align. We'll scrutinize their data and assess their progress. By the end of this deep dive, we'll have a much clearer picture of their true commitment to sustainability.
All right, welcome back to our deep dive into Fineotex Chemical Limited. We've established that they're a company on the move, but now it's time to get down to brass tacks and really dissect their financials. Where do we even begin?
Let's start with their revenue growth, shall we? You mentioned earlier they're boasting some pretty impressive numbers. A 41% jump in income from operations last year, reaching a whopping INR 41,893 lakhs. It's not chump change.
It definitely caught my attention, but we need to understand what's driving that kind of growth. Is it all organic, coming from within, or are acquisitions playing a part in the success story?
Well, if we look at their annual report, it highlights that a significant chunk of this growth can be attributed to the expanded capacity at their Ambernath plant. Remember, they ramped up production to a substantial 104,000 MTPA.
Right. They're really scaling up their operations. That's a big move, signaling they're banking on sustained demand for their products. But is this expansion primarily driven by those existing product lines, or are they branching out into new territories as well?
It seems to be a combination of both. They've mentioned the development of new products and are actively expanding into those new markets we talked about earlier, like oil and gas and water treatment.
And speaking of new products, you mentioned AquaStrike Premium earlier. It sounds like they're betting big on this, but what exactly is it? Fill me in.
It's a bit of a mystery, to be honest. It's a new addition to their product line. That much we know. But the specifics, they're a little vague in the reports. Based on what they've said, it's probably some sort of high-performance chemical formulation, something designed for specialized applications. The fact that they highlighted it during their earnings call tells me they see real potential there, a significant market opportunity.
So new products, new markets, expanded capacity, they're firing on all cylinders. But let's be real, this kind of aggressive growth usually comes with a hefty price tag. What's their debt situation look like? Are they leveraging themselves heavily to finance all of this?
And this is where it gets really interesting. One of the most striking things about their financials is that they're virtually debt-free. Can you believe it? They've achieved all of this growth while maintaining a remarkably low debt profile.
That's incredible. It speaks volumes about their financial discipline and their focus on sustainable growth. But, it makes you wonder, could this conservative approach also be a sign they're being a little too cautious? Are they potentially missing out on opportunities to grow even faster by taking on a bit more debt, especially in today's low interest rate environment?
That's a valid point. It's a classic dilemma for businesses. How do you strike that balance between prudence and the need to seize opportunities? It's a trade-off that investors need to weigh carefully.
Absolutely, something to ponder. Now, let's shift gears and talk about their profitability. A 35% jump in profit after tax last year, reaching INR 12,102 lakhs. That clearly indicates they're doing something right. But how sustainable is this level of profitability? Can they keep this up?
To answer that, we need to look beyond those top-line numbers and delve into their EBITDA margins. That's a key indicator of operational efficiency. It tells us how effectively they're converting revenue into profit.
All right, break down those margins for me. What are they telling us? How healthy are they?
Their consolidated EBITDA for FY24 came in at a solid INR 14,838 lakhs, with a margin exceeding 31%. That's a very healthy figure, suggesting they're running a tight ship and effectively managing costs.
So it's not just growth, it's profitable growth. Now let's talk about their capital expenditure, their investments in the future. How much are they pouring into their growth, and where are those investments being directed? Are they investing wisely?
Their annual report shows they invested a substantial INR 1,346.16 lakhs in fixed assets during the past year, with a good portion of that going towards the expansion of their Ambernath plant. This aligns with their strategy of boosting production capacity to meet that anticipated demand we talked about.
So they're putting their money where their mouth is. It's a big bet on the future, but are these investments actually paying off? Are they seeing tangible returns?
Well, their return on equity, or ROE, paints a positive picture. It exceeded 35% for FY24, indicating they're using shareholder funds very effectively to generate profit. It suggests that, yes, those investments are yielding positive results.
So they're growing revenue, expanding capacity, generating healthy profits, all while maintaining a low debt profile. It paints a pretty impressive picture of a financially sound and well-managed company. But, we can't ignore the external factors that could impact their performance down the road. What are some of the headwinds they might face?
Right. No company operates in a vacuum. The global economic landscape is always a factor. If those major economies slow down, it could impact demand for their products. And we can't ignore inflation. Rising input costs could squeeze their margins, even if they're managing costs well.
So even with a solid foundation, they're not immune to those macroeconomic challenges. And what about the competitive landscape? How do they stack up against their rivals?
It's a competitive industry, that's for sure.
Yeah.
They're facing competition from both domestic and international players. As they expand into those new markets, they're going to encounter new rivals with established footholds.
So maintaining their competitive edge will require them to be agile, innovative, and really understand the nuances of those new markets.
Absolutely. And that brings us to another crucial aspect, the successful execution of their growth strategy. They've laid out some ambitious plans, but translating those plans into tangible results requires flawless execution. It's one thing to have a plan, it's another to make it happen.
That's where the rubber meets the road. What are some of the potential hurdles they might encounter in implementing this grand plan? What could trip them up?
Integrating new acquisitions can be tricky. It requires careful planning and a delicate touch to ensure a smooth transition and avoid those cultural clashes or disruptions to their operations. Expanding into new markets also presents its own set of challenges. They need a deep understanding of local regulations, customer preferences, and the competitive dynamics in each market.
So they can't just waltz in and expect everything to fall into place. They need to do their homework and be prepared for a steep learning curve. What about the human element? Can they attract and retain the talent they need to support these ambitious plans?
The people factor. It's a critical piece of the puzzle, especially in a specialized field like chemical manufacturing. They need to offer competitive compensation and benefits, create a positive and supportive work environment, and provide opportunities for professional development.
It's about more than just salaries and benefits. It's about creating a culture that attracts and retains top talent. So, with all these potential challenges, how have they navigated similar obstacles in the past? What's their track record?
Well, if you look back at their history, it shows a remarkable level of resilience and adaptability. They've successfully weathered economic downturns, overcome competitive pressures, and expanded into new markets. They've been through the ringer and come out stronger.
So they've got a track record of overcoming adversity. That's a good sign. What are some of the factors that have contributed to their ability to weather those storms? What's their secret sauce?
I think a few things stand out. They've got a strong and experienced management team at the helm. They've adopted a disciplined financial approach, avoiding reckless spending and excessive debt. And they've consistently invested in innovation and sustainability, which has helped them stay ahead of the curve.
So they're not invincible, but they've got the experience, the tools, and the mindset to navigate the inevitable challenges that lie ahead. That's a key insight for potential investors.
Absolutely. It underscores the importance of ongoing due diligence. Investors need to stay informed about the company's progress, keep tabs on their financial performance, and assess how effectively they're adapting to the ever-changing market landscape. It's an ongoing process.
It's a dynamic situation. Investors need to stay engaged, stay informed, and be ready to adapt as new information emerges. Now, let's shift gears and delve into another critical aspect of FCL, their commitment to sustainability and ESG principles. We've touched on this before, but I think it deserves a deeper dive.
Agreed. They've made some bold claims about their sustainability initiatives, but now it's time to see if those claims hold water. Are they walking the walk, or is it all just greenwashing?
Let's peel back the layers of their sustainability story and find out, where do we even begin with this? There's so much information to consider.
A good starting point is their environmental initiatives. They've talked about a whole range of programs, from energy conservation and waste reduction to promoting sustainable sourcing practices throughout their supply chain. They've even installed a solar power plant at their Ambernep facility. But are these initiatives truly making a difference? Are they having a meaningful impact on their environmental footprint?
They've got a lot of initiatives on the books, but as you said, actions speak louder than words. We need to see results. So how do we gauge the impact of their efforts? What should we be looking for?
Transparency and accountability are crucial when it comes to sustainability. We need to see that they're tracking their environmental performance using real data and metrics. Are they measuring their energy consumption, their waste generation, their water usage? Are they setting targets for reduction and then reporting on their progress toward those targets? That's what separates the genuine efforts from those who are just trying to greenwash their image.
Okay, solid points. We need data, we need metrics, we need proof. What about their social responsibility initiatives? Are they giving equal attention to the S in ESG? Or are they just fixated on the E, the environmental side of things? What about the people?
It seems they're not neglecting the social aspect. Their reports highlight programs aimed at employee well-being, diversity and inclusion, and community engagement. It's encouraging to see them taking a holistic approach.
It's all well and good to have those programs, but are they actually effective? Are they moving the needle on those social issues? Are they measuring their impact?
That's the key question. Are they measuring employee satisfaction and diversity metrics? Are they tracking their community investments and the outcomes of those investments? Are they genuinely creating a more inclusive and equitable workplace? Are they truly making a positive contribution to their communities? We need to see the evidence to assess the effectiveness of their efforts.
Right. It's not enough to just talk about it. They need to show that they're making a real difference. And lastly, we can't forget about the G in ESG, the governance piece. How are they ensuring ethical conduct and responsible decision-making at all levels of the organization? Are they just ticking boxes, or is their commitment to good governance deeply ingrained in their culture?
They've certainly emphasized their robust corporate governance framework. They talk about their code of conduct, their whistleblower policy, and their compliance monitoring systems. These are all essential components of good governance. But the real test is whether these structures are effectively implemented and truly embedded in the company's culture.
So, how do we assess that? How do we determine if their commitment to good governance is genuine, not just window dressing?
We need to look for evidence that ethical considerations are being woven into the fabric of their decision-making processes. We need to see that they're holding themselves accountable to their own standards, even when it's tough. We need to see that they're being transparent about their challenges and how they're addressing them.
It's about walking the walk, not just talking the talk. It's about aligning their actions with their stated values and principles. So how can we assess whether their sustainability efforts are truly integrated into their business practices? How can we tell if it's more than just a side project or a PR campaign?
That's where things get a bit more nuanced. We need to look at how sustainability considerations are factored into their strategic planning processes, their investment decisions, and their day-to-day operations. Are they making those tough choices, those trade-offs between short-term profits and long-term sustainability? Are they holding themselves accountable for their environmental and social impact, even when it's difficult or costly? That's what true commitment looks like.
Those are the tough questions that separate the truly committed companies from those who are just jumping on the sustainability bandwagon. We need to dig deep, look beyond the surface, and uncover the truth behind their claims.
Absolutely. As we continue our deep dive into FCL's sustainability story, we'll keep those questions in mind. We'll look beyond the headlines, scrutinize the data, and provide you with a clear and insightful assessment of their ESG performance. We'll separate the substance from the spin, the real from the rhetoric.
It's time to see if FCL is truly living up to its sustainability promises, or if it's all just green smoke and mirrors.
Let's peel back the layers and find out. We'll examine their environmental initiatives, their social responsibility programs, and their governance practices in greater detail. We'll compare their actions to their words and see if they align. We'll scrutinize their data and assess their progress. By the end of this deep dive, we'll have a much clearer picture of their true commitment to sustainability.
All right, welcome back to our deep dive into Fineotex Chemical Limited. It's the final stretch. We've covered a lot of ground already, exploring their financials, growth strategy, risk management, sustainability efforts, and their corporate governance practices. But before we wrap things up, there's one more piece of the puzzle we need to examine, those hints they've dropped about a potential acquisition.
Yeah, acquisitions can be a real game changer for companies, you know. They offer a fast track to growth, a chance to quickly expand into new markets or add new products to their portfolio. But of course, acquisitions come with risks too. FCL needs to choose carefully and make sure any potential acquisition aligns with their overall strategy. They need to make sure it's a good fit and that it adds real value to the business.
Right, it can't just be a random grab for growth. It needs to be strategic. And they've been pretty tight-lipped about the specifics, just dropping a few hints here and there during their earnings calls. So based on what we know about their goals, what kind of company would make a good match for them? They've mentioned market expansion, product diversification, and strengthening their sustainability profile. It's a pretty tall order.
Let's break it down. First, market expansion. They've already made some inroads in the Middle East and Southeast Asia, but they've expressed interest in expanding their presence in Europe and the Americas. Acquiring a company that already has a strong foothold in those regions would be a huge advantage. It would give them instant access to those markets.
So not just a distributor, but a company with existing manufacturing facilities, a network of customers, and a deep understanding of the local markets. That would certainly give them a head start, wouldn't it?
Exactly. It would save them the time and expense of building a presence from scratch. Now, let's think about product diversification. They've smartly moved into the oil and gas and water treatment sectors. But where else could they leverage their core expertise and diversify that product portfolio even further? What other industries or applications might be a good fit?
Well, they've talked about their commitment to innovation and developing those high-value, specialized products. So what kind of companies or product lines would align with that vision? What would complement their existing strengths?
One possibility is to target companies that specialize in niche applications within their existing markets. Think high-performance coatings for textiles or advanced water purification technologies. Those could be a good fit. Or they could even venture into bio-based chemicals for the agricultural sector. That would align nicely with their sustainability goals, tapping into that growing demand for eco-friendly products.
Oh, that's an interesting idea. A move into bio-based chemicals would definitely enhance their sustainability credentials and open up some exciting new avenues for growth. And speaking of sustainability, that's got to be a major consideration in their acquisition decision-making, right?
Absolutely. It's a top priority for them. They've built a strong reputation for ethical and sustainable practices. They wouldn't want to jeopardize that by acquiring a company with a questionable track record on the environmental or social front.
Right, they wouldn't want to take two steps back after all the progress they've made. So no cutting corners on environmental compliance or labor standards. Any potential target needs to share their values and commitment to doing business the right way. But how can they really assess a company's sustainability performance before they pull the trigger on an acquisition? It's not always easy to get the full picture.
That's where due diligence comes in. It's crucial. They need to thoroughly vet any potential target. They need to examine their environmental and social impact, their governance practices, and their overall commitment to those ESG principles. They need to make sure the company is walking the walk, not just talking the talk.
So it's not just about the financials and market share anymore. It's about finding a company with a compatible culture, shared values, a similar approach to doing business. It's about finding a partner, not just a purchase.
Precisely. And they need to go beyond those self-reported sustainability reports. They need to talk to people, engage with stakeholders, employees, customers, suppliers, community members, get a real sense of the company's reputation and how they operate in the real world.
It sounds like they're taking this acquisition decision very seriously. They're not rushing into anything.
They shouldn't. A poorly thought out acquisition can do a lot of damage to a company's bottom line, its reputation, its long-term prospects. It's a high-stakes game.
So the stakes are high, but the potential rewards are significant too. If they do their homework and choose wisely, an acquisition could really propel their growth and maybe even help them make a bigger positive impact.
Couldn't agree more. And that about wraps up our deep dive into Fineotex Chemical Limited. We've explored their business from just about every angle, shining a light on their strengths and uncovering some potential challenges along the way.
It's been a fascinating journey, that's for sure. We've uncovered a lot of information, a lot to think about. So, for our listeners out there who might be considering an investment in FCL, what are the key takeaways? What should they keep in mind?
Well, the first thing that stands out is their strong track record of financial performance. They're consistently delivering solid results, growing their business, and managing their finances responsibly. They're clearly committed to innovation, and they're strategically expanding into new and exciting markets.
They're not just sitting still, they're actively pursuing growth opportunities.
Exactly. And their focus on sustainability and ESG principles is another big plus. It's clear that they're not just chasing profits, they're trying to make a positive impact on the world.
It's refreshing to see a company that takes its responsibility to the environment, to society, and to its stakeholders seriously. But, we have to acknowledge the risks too.
Of course, they're operating in a competitive industry, they're facing those global economic uncertainties, and their ambitious growth strategy comes with its own set of challenges. It's not a guaranteed win.
So potential investors need to weigh those risks carefully. They need to consider the big picture, the long-term view.
And remember, due diligence is an ongoing process. It's not a one-time thing. Investors need to stay informed about FCL's progress, keep tabs on their financial performance, and see how they adapt to the ever-changing market dynamics. It's about staying engaged and informed.
Wise words. This deep dive has given our listeners a solid foundation, a comprehensive overview of Fineotex Chemical Limited. But it's just a starting point. It's up to each individual investor to dig deeper, ask those tough questions, and determine whether an investment in FCL aligns with their own investment goals, risk tolerance, and values. It's a personal decision.
Absolutely. We've provided the information, the insights, the tools to help them make an informed decision. Now it's up to them to do their own research and come to their own conclusions.
And that brings our deep dive to a close. We hope you found this journey insightful, informative, and maybe even a little bit inspiring.
It's been a pleasure sharing these insights with you.
Thanks for joining us on this exploration of Fineotex Chemical Limited. And remember, the world of business never stands still. It's constantly changing, evolving, throwing new challenges and opportunities our way. So stay curious, stay informed, and never stop.